Hi, this is Ira Zlotowitz, founder and CEO of Japarency. What we're going to accomplish today is to teach you how to underwrite a commercial real estate deal. It might seem daunting at first, but by the time you walk out of here, you'll be able to underwrite a deal like a pro. During my 25-year career in commercial real estate, I was fortunate enough to train tens of thousands of people to enter and be successful in the commercial real estate space. I've merited to have built the third most active commercial real estate mortgage brokerage firm in America. As the saying goes, a deal is only as good as the financing it gets. In order to finance a deal properly, you have to be able to underwrite a deal properly. There is one thing that I have an edge over almost all people in the business world. And I'm not saying it to brag. It's actually unfortunately humbling. Most people are lucky enough to have a business where people engage them. You walk into a store, you buy something. You engage a service. In my business, we get nothing up front. Everything was on spec. I hire someone. They want me to advance them money against commission. We take on an assignment. We spend money. We have to wine and dine the client. And if and when the deal closes, we get paid, and that's when we could split the profits at that time. Sitting in the seat as the president of the third most active commercial mortgage brokerage firm allowed me to see every deal from all perspectives. How it works for the seller, for the buyer, for the broker, for the tenant, for the banker, and see how it all comes together and what their perspectives are. So this way, when you know every perspective, you can know early on that if there is going to be an issue, what's the best way to solve it, and what is each person's ulterior motive. So I'm trained into one art, to see what can go wrong and then be able to problem solve until the closing. Because if I could notice early on that this deal is not going to happen and I abort mission today, I'm not putting good time or good money after bad time or bad money, then it's a very high probability I'll be able to take on another deal that can get to the closing table and be profitable. So to me is asking those questions, following the way the wind blows. What nuances can I pick up that are going to allow me to realize, hey, this is going to go to the closing table, and this won't unless the client is willing to move forward. My goal today is to teach you how to look at a deal and be able to early on ascertain if it's worth your time to spend a minute, an hour, a dollar, a nickel, hundreds of dollars if you're going to take it to the closing table. Before we go down the path of actually underwriting a deal, I want to tell you the 4 steps that you must follow so you don't waste your time and you maximize the best ability to be successful in the real estate game. Number 1 is find out how much money you have to play with first. Don't look at a deal first. First go to your network. See how much money will your network willing to give you to invest in a real estate deal. Can you put together $500,000, $1 million, $10 million, $100,000? And whatever number that is, reverse engineer that number into how much of a building you could afford to buy. Keeping it simple without closing costs. Imagine you could only put together $500,000 and banks will lend you 75%. That means you could buy a $2 million building. You put up $500,000 of equity, that's the money you're putting into the deal, and you're borrowing the rest, $1.5 million. Forget about closing costs, keep it simple. You can't bid on a building for $2.1 million because you don't have money for that. So therefore, you want to first start with how much money do you have? Number 2, once you figure out how much money you have, what kind of return does that money need? What's the IRR? In today's market, yesterday's market, the future market, it doesn't make a difference what the past was, what the future is going to be. Today, the $500,000 that you just said you could get, what IRR does your money need? And if your IRR they need is an 18% IRR, you can't look at a deal that's throwing off only a 16%. Now that you get this, start looking at deals. The third piece is using the cap rate in relation to the NOI to figure out the value. The NOI is the net operating income. The cap rate is a numeric number, I'll get into it later, the details of it, that tells you what the building is worth. For now, go to your guru and ask your guru, what cap rate should you apply to a building? So you take the NOI, apply the cap rate. That has to work for that $2 million number. So you might have someone telling you they're selling you a building for $2 million, throwing off 18%, it works so far, right? But when you apply the cap rate that this person tells you, then the building is selling for $2.1 million. Then obviously you can't take that building. Fourth is once these first 3 things go well, then you want to make sure that you confirm the numbers that got you to that NOI. You want to work through that NOI. You went to a number that the building has $200,000 of NOI, equivalent of $200,000 of profit of the building. But does it really? Maybe when you start doing due diligence, you're going to realize, hey, there's an expense was left out. Hey, this income is not going to be recurring next year. You really only have 194. Now reverse it. At 194, does the cap rate still give the value less than $2 million? Does it still throw off the 18% return? If yes, you could reverse it and it pays to go forward. I find so many people go the opposite. Let me first look for a good deal. How do you know what a good deal is? A good deal is based on your source of money and the returns that your source of money needs. From a very, very high level, underwriting really boils down to two parts of the process. There's until you get to the NOI. That means you take the income, you verify the income, underwrite the income, compare comps, go to the expenses, underwrite the expenses, compare comps, and figure out what the correct NOI is. The second part is once you have the NOI, making sure the business terms work. What leverage can you get from the bank? What loan to value? What interest rate could you get? What does it work out to get to the IRR? What are the partnership splits? How much equity do you need to come up with? What's the max loan a bank's going to lend? That's the second part. What we're going to focus on this course here is the second part. Because the first part, you should go into it, like I said before, assuming that the NOI was accurate. Assuming that you got it was correct. And move forward now if the business terms work. Then and only then you say, hey, I checked the 3 boxes. Now go to box 4. Work with someone who's an expert that can help you. You can't take an underwriting course in a minute, in an hour, in a day, in a week. It's a lifetime to master. When you're ready to buy that deal, at that time, it's worth paying someone that's an expert to underwrite that deal and be able to go ahead and move forward. So I'm going to teach you a high level of how all these numbers should work so you could appreciate what's going on. But when you're really buying that complicated deal, you should be able to then have someone that's going to work with you that's an expert underwriter to make sure that the NOI is confirmed as the correct NOI. Now, let's go. So with every deal that you're probably going to underwrite, somebody sent you the deal. You could either be a buyer, a GP, a syndicator, and you got a deal from a broker. Or you're an LP, you're a limited partner, and a GP, a syndicator, sent you the deal. You have what's called an offering memorandum. The lingo is an OM. Now that you have that, what do you do with it? How do you make sense of it? If you want to call up your guru and to ask of certain assumptions, how does it start making sense to you? So let's start here. What I'm going to do now is while I'm talking to the camera, I have someone here with me that is going to be using the transparency calculator. So it typically will start with the property. So you do a search, bring yourself to 520 South 2nd in Illinois. That's the property we're looking at. Everything here is fictitious. There's no real deal that we're talking about. I'm going to use for illustration purposes numbers that you can imagine going through it. So the first thing you're going to do is look at the OM. What is the purchase price it says? Let's go in this case, it's $10 million. So put $10 million as the purchase price. The next thing you're able to do is the NOI. The NOI stands for net operating income. In every single industry of the world, they have different terminology which is called profits. In the accounting world, there's GAAP. That's the lingo when they want to get for the profits of business, they use GAAP. It's an accepted practice that accounting practices. In real estate, NOI means net operating income. What's the income minus the expenses and assuming that you're using the regular underwriting guidelines, how people underwrite deals. So for us right now, really you could just take the number that you see in your document that says, hey, NOI is $100,000, $500,000, $600,000, plug it in. We are building out, we have the ability to take the high level numbers that you see, and there's typically 3 numbers that are very important. So for right now, you get the expansion by NOI. And the first thing you do after you get the expansion is the revenue. That's the potential gross income. Potential gross income is assuming that the whole entire building was fully rented. What is the income of the building? So if you have a building that has $500,000 in income, let's say, right now, and there's enough space in the building to rent out another $700,000 worth of space, the potential income is $1.2 million, but it's not fully rented. So you'd have to underwrite and take away a vacancy. A vacancy is another word for emptiness. There's nothing there. Either actually nothing there, or at a minimum, apply a vacancy. So let's go in a normal case with the deal you're looking at, has potential gross income of $1.2 million. The vacancy is 0, but no one buys a building assuming 0. There's going to be maybe a tenant not pay once. Maybe you're going to have a collection loss. You're going to have a gap when a tenant leaves before you rent out to the new tenant. They always put a 5% vacancy. So now plug in a 5% vacancy. For the expenses, you could put in $500,000. Expenses are what are the operating expenses of the building is $500,000. But I want to go off on a little bit of a tangent here. If you're really doing due diligence, right now we're just trusting the numbers that you were sent in your OM. from the broker or from the GP. Assuming these numbers work at this level and you go to the end of the movie, then you could come back to this page and really start spending a lot of time and effort to confirm and verify every part of the numbers. So for right now, you're going to plug this in. And also, with these numbers that they're coming in are really telling you what they're expecting the first year. When they're giving you these numbers, it's expected year one. So you're able to plug in over here now what's called the T12. When you see in real estate the letter T, it stands for trailing, and the number after that is typically months. So the trailing 12 months, you could put in right now the historical. So you could see in this case, for example, the T12 was maybe $1 million, and the T12 had blanket expenses. But for right now, just to keep it there as a reference point, and now you're projecting, so you notice, hey, now you want $1.2 million as your projection. I was taught, be like a detective. 1 second. You have $1 million of income last year, and you're expecting $1.2 million of this year? Is that a big jump? Ask questions. And if you have your own independent guru you ask questions to, say, does that make sense? And then you'll be able to see the beginning of the flag. But once you type in these numbers quickly, now you have on this building here, it tells you that the NOI for this building is $640,000, because you have $1.2 million, 5% vacancy after $1.2 million, $500,000 expenses, give you a 6.4 cap. That's the easy lingo. Cap rate is the short form for capitalization rate, which means if you bought this building for all cash, you didn't take a mortgage, you paid $10 million, and all you got back was $640,000, how much is your return? What is your capital return? Capital in, equity in, that money you put into the deal, and money you took out. Using the example we were saying before about if you have $500,000 to invest, if you put in $10 million, no mortgage, not $500,000, and you took out $640,000, it's 6.4%. At this point, the only thing you have to know about cap rates is two things. What does the formula work for? 6.4%. And then have your lifeline, have your guru. Mr. Guru, I'm buying this building in Illinois. What's the cap rate I should buy this building for? How low of a return should I be willing to make? In effect, is another word. What's the cap rate? What is the lowest cap rate I should buy this building for? That's all you got to know. Forget about getting off on a tangent. It's complicated cap rates. You just want to simply take the NOI and apply a cap rate. And if in this case your guru says, you don't buy a building in that area less than a 6.9, so you know what you do? Click on the tab which says cap rate, and then just change it from 6.4 to 6.9. And instantly that second it's going to say that if you had to buy this building with a 640 NOI, but you can't pay less than a 6.9 cap, that means you're not willing to make less than 6.9%. You know how much you bought this building for? $9 million too. Before you spend another minute on this deal, a nickel, a penny, anything, you pick up the phone to the person who called you up. Let's go with this case from now on, you're the GP. You got this deal from a broker. You call up the broker and say, Mr. Broker, I started to do the underwriting. I know it can only get worse as I go down the line, but I can tell you now, there is no way that I could pay more than $9 million too. Is this still an option? If he says, no way, I have a ton of bids higher, irrelevant to you, because your guru is telling you it's not worth it. If the broker says, 9.2, this is what to work with, we could talk to, then, depending on how you read that wind, decide to go to the next step. So now, at this point right now, the next step is closing costs. So the full due diligence really would allow you on this here to open up the closing costs and see a whole list of every single possible closing cost that could exist on a transaction. The appraisal, that's the person who's going to come down and do an appraisal to figure out, to tell you what the value is. An appraisal is not a scientific answer. It's an opinion of value. That's what an appraisal is. Then you could have, is there any environmental reports that have to be done? Do you have to go to check, is there any environmental issues on the building? Because if there are, you don't want to buy a building that has environmental issues. So the person buying a building is want to make sure that they're covered if there's environmental issues, there's expenses there, there's engineering, maybe the structure of the building has an issue. And then you could have the borrower's legal. You have legal fees to close the transaction. Then you could have a bank's legal. Then you could have other fees on the transaction. You could have the mortgage broker's fees. You could have the sales broker if the buyer is paying for it. Title refers to title insurance. Title insurance is regulated on the price. Every single state has a regulation of how title works. Every bank is going to require title insurance. Title insurance is actually the only insurance that goes on the past, not on the future. When you have life insurance, car insurance, fire insurance, theft insurance, it's what if something happens in the future? Title insurance is saying is that this title, you're buying the building today, and you're being told that at the closing, no one has any claims to it. What happens if someone knocks on your door the next morning and says, hey, I really own this building, or I'm owed $100,000 on this building? Title insurance company does searches, and then they insure the results that if someone makes a claim later, then they can't make a claim to this property, and they're going to cover it if there's a problem. You could have all different expenses that are going to go onto a transaction that potentially could go in. So sometimes, to go into the nuanced details of it, I don't want to keep going here, because what ends up really happening in most cases, most people have this rule of thumb. And the rule of thumb is, I buy a building, let's use 3%. So whether you use 3%, whether you use 2%, whether you use 4%, you have your guru you work with, that's called your assumptions. What assumptions do you use? Plug in the assumption. In this case, let's plug in 3%. When I came into this business, there was no such thing as a value-added deal. Person bought a piece of real estate and they worked it. Today, everything's very scientific, as you'll see. And in this world, most deals in this marketplace have what's called a capex, capital expenditures. How much money are you putting into this deal right after you buy it? So we have now $10 million purchase, or in this case, we're down to 9.2 million purchase, plus we have 3% closing costs on the 9 million too, plus I expect to do X number of dollars in renovations. So you could easily plug it in right here. For the example we're using today, I'm not going to plug it in. But I want to tell you the power of the calculator is that when you do plug it in, it's going to automatically now add it to the 3% and the capex number. So it's very easy if you do a back of envelope, because you could take 3% and the lingo using is capex. And also, it's going to trigger that later on in this presentation, when you're going to have a deal and you want to calculate what the cash flow in the future is going to look like, it's going to know to ask you, hey, you put in capex, so what is the stabilized year? You have $1.2 million, your projected income. What year is that going to be, right? Because that's when I'm buying a building. You say, hey, I'm buying a building for this price. I plan on putting money in. What's the year? Sometimes the stabilized year is year 1. Sometimes it might be year 2 or year 3. So to help you calculate it, this way, it's not that complicated. You can just plug in a number later on and answer that number. But I want to go with a straightforward deal without the word capex in it, and then go ahead and keep moving forward. The next thing we're going to put in is the mortgage. So in a case like this, you could call up your mortgage broker. One of the free tools that your parency has is right here. Be able to tell you what rates could you expect, what property type, and what market. The rate sheet here will tell you the rate. Let's say, just for keep it simple, let's assume the rate is 6%. Just type in 6%. Let's go now, you want to talk about the loan amount. So there's primarily 3 different ways that you want to use the loan amount for the back of the envelope type of assumption. Loan amount number 1 is just, there's the amount of money you're borrowing. Number 2, which is the more common one, starts with a % of the purchase price. So you're buying this building for $9.2 million. I'm getting, the bank is willing to lend you 75% of $9.2 million. And then it will calculate for you what the loan amount is. Sometimes it's about capitalization. It's not about just the loan amount. It's about the total cost. I have a lender, because I'm putting a lot of work into it, similar to a construction loan, right? A construction loan is basically capex on steroids. But it's really, you're doing a ton of work on it. In that case, many lenders focus on a % of the total capitalization, which means the total cost of this deal. And in that case, you could do the same thing you could do with toggle here. So under the 75, you could do 75% of the purchase price or 75% of the capitalization. One of the things I plan to build future into it is for those that have heavy capitalization and sometimes different types of deals where it's a split calculation, where you put in, I get 75% of the purchase price and 90% of capex, but 95 to 100% of deals that are typically going down, obviously say 99%, typically it's just one metric, either or. Then we have what's called the loan terms. When you're doing a loan with a bank, there's no such a thing, I shouldn't say no such a thing, but very rare, maybe a HUD loan, where you're taking a loan like for 30 years and fixed for 30 years. That's a home mortgage. But when it comes to commercial real estate, banks and many borrowers don't want to lock in a long-term rate, because when it comes to commercial, there is no government protecting you. When it comes to a homeowner, the government wants to protect the person buying a home. This person could be a genius mathematician, a genius doctor, a teacher. They know they bought a house, they want to take a mortgage and pay the same payments for the next 30 years. But if you think about it, look what happened now. Interest rates spiked up. Can you imagine all those lenders that made loans at 2% and now rates are up at 4% or 6% or 8% and goes up and down? People could lose a lot of money just from that. For the next 30 years, they have to honor that rate. When it comes to commercial real estate, most loans are like adjustable rate mortgages, but even worse. It has a balloon payment. You take a loan today at, let's say, a 10-year loan. At the end of the 10 years, you don't have an option to continue for the next 30 years. You have to stop at the end of the 10 years. So the way I describe it is that there's a 30-year mortgage. But after year 10 of the 30, that's when you have to refinance. So the loan term means that interest rate that we just discussed, that's 6%, for how long is the bank committing to stay with you for how many years? That's typically what this lingo means. Sometimes it could be, I have a loan for 10-year commitment, but the rate may change after year 5. We're going to assume that the interest rate which is the most common time. The interest rate matches the loan term. So in this case, let's put out a 10-year term. And we'll put out then amortization, 30-year amortization. So I want to talk about amortization. Amortization is the simplest way to think about it is that it averages the payments that you should be paying over the 30 years, so your payment becomes even, that by the end of the 30 years, assuming it wasn't a 10-year loan, a fixed rate, you had a 30-year fixed rate. If you made the same payments, consistent payments for those 30 years, what would your balance be? Really what should happen in a holistic, simple example is that if I would lend you $1 million and I would charge you 10% interest for 10 years, you know what should happen? At the end of the first year, you owe me $100,000, which is 1/10 of the million, to pay back 1/10, plus you owe me $100,000 in interest. The year 2, you owe me $100,000 again, plus only $90,000, because 10% interest on the $900,000 that you have of mine. So that's $90,000. Your payments are $190, then $180, then $170, and it keeps going down. But that's crazy. The biggest payment year 1, think about it. When you buy real estate, you talk about, I have a deal, a ton of upside. If there's upside, I want the lowest payment year 1, and then as time goes up, I want to get higher. The people who got in trouble in the last market, everyone is trash talking them. You didn't think it was coming. Let me tell you something. Even a broken clock is right twice a day. So for 20 years, people are rates are going down and staying low for the most part, and people are taking floating rates. Let me buy this building, take a lower rate now because the bank's is not pricing in that it might go higher, and then I'll refinance and put it to sleep for a longer term when I'm done. All of a sudden, the rate spiked up, comes the Monday morning quarterback and says, hey, I can't believe you did that. Is there a level where some people just doing crazy things? Of course. But for the most part, that was the accepted business that people were doing in a normal case with taking floaters. They bought caps. They bought different things to protect themselves. But it went so crazy so fast. No one thinks about these things when you're starting to do different stress tests. But I'm not here to debate that pro or con, but that's just the background of the mindset. So going back to amortization is taking that and saying, I can't afford to go from 190 down. What would happen? Take all my payments and average it out. What's my single constant payment that by the end of the 30 years we'd be totally finished? What we offer here on the calculator to the right side a little bit is the amortization schedule. So you can actually see what the amortization schedule looks like. On this transaction, if you click it, you will see how much is your payment, it's consistent, and then how much of that is going towards the bank's interest, and how much of that is going towards the bank's principal. And then at the end of that month, what is your balance? Go to payment number 2. Payment number 3, if you notice, it's the same payment, but the amount that's being allocated changes. So I want to tell you one pro tip that I learned when it comes to amortization and the mistake that people make. I meet people who say, most of the interest is paid up front, so I don't want to refinance my home on the last few years of my mortgage, even though it's a higher rate than today, because most of the interest, I already paid the interest in the beginning. Now I'm not paying interest. You're making a mistake. It's not that most of the interest is paid in the beginning. In the beginning, most of your payment is going towards interest. But as it comes towards the end, if you scroll down to the last year, it's just the opposite. The last payment is just the opposite. Almost all the payment is paying down principal. But that actual year, in the last year, if your balance of your mortgage is $82,000 of your last year, and you're paying a 14% interest, and without any cost you can refinance for 6%, you're saving 8% on that difference. So that's like a little bit off to the side, but I wanted to share the sentiment with you. Now let's go back to the general underwriting. Today, most deals come with what's called interest only. IO is the lingo for it. I'm buying a deal, going with the same theme. Tell the lender, listen, I know you have amortization. You want me every month to pay back principal and interest. You want me to pay back my principal, money towards the loan balance, and interest is your profits. But I have such a good deal here. It's going to be amazing. I'm putting money in. I'm working this deal. I want to have a lower payment. Is it possible that you could give me 1 year, 2 years, 3 years, 4 years, 5 years? Today it's probably more common along the range of max about 2 years today, but let's go with right now, you want to do 2 years of IO, which means that the first 2 years of this deal is going to be an interest-only payment. The next thing under this, I'm just going to show it to you, but it's not relevant for most of the deals, let's not focus on it, is what happens if you have a deal that also has other financings with it. So for example, you have secondary financing. At the same time, you might want to take a mezzanine, or you want to take a preferred equity. On these scenarios, just put in the amount that you're getting in there. It will use the same amortization, same schedule on top, and give you the total loan and the blended rate. What is a mezzanine loan? A mezzanine loan is banks don't really allow a second mortgage. So a mezzanine loan is like if you ever go into a theater, so you have the box seats at the bottom and then you have the upstairs. But then there's this gap in the middle. It's called mezzanine. It's not the second and it's not the bottom. Most loans are made to the property. You're lending money to the property, the first position on the property. A mezzanine loan is made to the LLC. When you buy a piece of real estate, you don't buy it as your name. I'm not buying it as Ira Zlotowicz is buying this building. I'm buying it as 123 Main Street LLC. In that case, I go out, the bank wants to lend me, in this case, 75%, but I want 80%. So I come back to the bank and I tell the bank, listen, could you go above it? They say no. So I find someone who's willing to lend me 5% to my LLC. The first bank is fine. They're lending 75% of the purchase price. The borrower, me, I'm coming to the table with 25%. My own equity, 20% of it, and 5% someone lent me to my entity. So that's called a mezzanine loan. The other type of loan is what's called preferred equity. I go to someone and say, do you want to invest with me? Well, I think I'm getting myself a great deal, a lot of upside. What we call value add. And I don't want to take a partner for life, have a partner. So I find someone who says, I'll tell you what, Ira, you have to put up $2 million in your deal, you're buying this deal. I'll tell you what, I'll lend you, I'll become your partner. I'll give you $1 million as equity. I'm called preferred equity, you know why? Because I get my money back first, meaning that you bought this building for $10 million, let's say you have loans for $8 million. You're short $2 million, I'll tell you what, I'll give you $1 million. I won't take half the deal. I'll take much less than half the deal. But I get my money back first. So I look at it, wow, I can now, in my top $1 million, and we'll see later on how all these splits work out, I only have to put $1 million out of my pocket. And I keep all the excess profit. It allows me to leverage. Leverage up, like you think if you have on a car, you're jacking up a car, every time you get leverage, every time you get someone willing to take less money than the building's throwing off. If a building is throwing off 6%, and then I'm paying a mortgage to the bank of 3%, the money I put in gets my regular 6%, what the building's throwing off, plus the profit, the difference between what the bank is taking and what the building is throwing off. Blended interest rate is assuming you have a first mortgage, a mezzanine, preferred equity, or any other mortgages, to sum it up into one number. What is that number? And then what does that work as an overall percent of a deal? Before the craziness of this last cycle, banks used to have certain rules. The most leverage in total. They don't care what you want to call it. They wanted to make sure that the GP, the general partner, the syndicator, had a certain amount of skin in the game. That if they're buying a building, X% of the money needed came from their pocket. And then you could go out to different sources at that time. So this is more on the sophisticated side of things, but this calculator allows you to plug those numbers in. Now, if you notice that as you plug all these numbers in, on the right side of the screen, and again, you could actually use this from a phone, and then just what's on the right side is at the bottom. But the right side of the screen now, while you were typing any number, instantly it was running the calculations. Let's go with the first number, total capitalization. How much in total are you putting into a deal? In the case where you have capex, you have 3 metrics going in: the purchase price, capex, and your closing costs. And then it says, based on how much you're borrowing, how much equity do you need? That's how much money I got to come to the table with. That's my equity need over here, the $2 million and change. Then I have principal and interest. What are the payments based on principal and interest? So it shows me the payments monthly versus yearly. And then it shows me debt service coverage, a 1.28 debt service coverage. DSCR stands for debt service coverage ratio. Debt is another word for mortgage. Service, I have to service the debt. Coverage ratio. What is the ratio? This building has an NOI and has a mortgage payment. How much after the mortgage payment am I left with as a ratio to the mortgage payment? In this case, it's 1.28. Again, you don't have to know how he calculated it, but what it really is telling us that for every dollar you're giving the bank, I have 28 cents that's left above that. If you look now on the IO period, where it's interest only, where I'm not paying any principal down, you look, my debt service is 1.53 because the payments are much less. So this same deal, in the first 2 years, I have a lot of extra money. Why? Because I want to do it to put more money back into the building. You have to think about it this way. If I didn't get this IO period, right, there's from $417,000 to $500,000 is the difference in payments. If I needed $300,000 worth of capex into this deal, and a bank wouldn't give me IO, think about this. I have to come up with $300,000. But if the bank is willing to give me IO, I only have to come up with $220,000 approximately. Because during the first year, I have an extra $80,000 in cash flow to put back into the deal. So I have to put up less money. It affects my return and my splits and everything else. So that's why to see these numbers side by side. But here's the biggest mistake that most people make, and that's why we have it here, the max loan from debt service coverage. So when you're going to go back to right above the loan amount, you're going to be able to put in what is the minimum debt service coverage ratio that a bank requires. So I just showed you this example over here. of 1.28. If a bank comes back and you put the number in and says, the minimum debt service we need is not 28%, you have to have 1.3, 30% buffer. It will tell you on the right side here, next to it, say, during this period, you can't borrow this amount of money. You have to borrow a little bit less. A lot of mistakes that people are doing, they're taking out loans, and the underwriting is that, they run the numbers very quickly, and they say, it's 75%. I spoke to him. The rate is this. I could borrow blank dollars. They find out later, based on underwriting, they missed this point. They find out too late. So here, this sticks out in front of you. Find out what the bank's minimum debt service coverage is, so you'll know while you're doing your underwriting if it works. Similar to when you went to the top of this. And this is a very important feature. When we started, if I showed you a 6.4 cap, and then but my guru says 6.9, right away before you went further, you realized don't pay more than $9.2 million. Same scenario is you're not going to be able to borrow more money than this. Now we'll keep going down to a few more totals that it gives you on the right side of the screen as we go down to the bottom corner. Maturity balance means, is like we said before, there's a 10-year term, there's a 30-year amortization. What happens, what is the balance of the loan going to be at the end of the 10 years? So the maturity balance, when this loan matures, you have to pay it down, what is the balance going to be? The reason why this is important is because later on we want to calculate different types of profits when you sell the building. You want to know at the time you sell the building what the balance is. If you sell the building later on for $12 million, how much will your balance be? So you have $12 million the sale price minus closing costs minus the payoff, maturity at balance. So you have now the payments, and now you want to see what are the totals that you have. First year cash flow. You have your NOI, and you have your payments. What is your cash flow afterward? The second thing is what does it work out to the first year cash on cash? If you're putting in that capitalization, that equity required on top, and you're profiting $222,000, that's an 8.5% cash on cash return. Cash on cash is the simplest number to use on the first year. It's very simple. How much did I put in cash? How much did I take out? When all is said and done, you wrote a check for this amount, and you pulled out this amount, it works out to 8.57. Bank debt yield is another number that's important when you're talking to banks. It's the same equivalent as a cap rate, but instead of going from the NOI to the purchase price, what's the relationship between the NOI and the loan amount that the bank is giving? And the banks can have different metrics to go forward from here. This is the first round where most deals are left to die. By the time you get past this page is when you realize most of the deals you shouldn't continue. These are the tweaks, these are the questions to ask. But if you take it past this, now you want to say, okay, the numbers look right, the price looks right, assuming the NOI is accurate. Now let's go to the investment returns. Now we're coming into an area where almost all real estate professionals have no idea themselves how to make these calculations. They rely on complicated models. They rely on a senior analyst to get these numbers for them. What I'm providing here is not going to replace any of those people. Just like I always say with ChatGPT, it's not replacing me and you. But if each of us uses ChatGPT, we could do a lot more quicker. Look how quickly we're able to get to these numbers. So the idea over here is not to get it down to perfect. The idea is to get it close enough that you could calculate that other step, that IRR. Can you calculate what is the internal rate of return going to be? IRR, which stands for internal rate of return, means what did my money earn me, assuming that based on when I got the money back, it's not just taking the average. It's not like if I made 8% year one and 10% year two and 12% year three, I averaged 10%. That's average cash on cash. That doesn't really mean much. IRR takes into account not just what I got back, but when I sell the building later and I get that one lump sum payment of the net proceeds of the sale, plus present valuing when I got the money back. So a deal that pays me 8% year one, 10% year two, or 12% year three, averages out to 10%. A deal that pays 0, 0, 30 also averages out to 10%. But when it comes to IRR, internal rate of return, depending on when and how fast you got that money back, that is going to be the difference in how it calculates the IRR of the deal, present value. You don't have to know all these sophisticated things. You just have to know, based on what we're going to show you here, what converts to the IRR. So go with confidence that it's in the 90th percentile, at least close enough. Once you get this, like I said, you're taking a deal serious, that one deal you take serious, it's worth it to get that expert. So I meet a lot of people when it comes to confirming numbers and underwriting, they said, I can't afford a top tier, whatever top tier means to you, because I do it once a week. But if you're only doing once a month, could you afford a top tier? Yeah. I use the example of Uber. When Uber first came out, people used to say, how could I be an Uber driver? I make so much less money. I used to get $100 to go to the airport. Now I only get $75. But when you took a run to the airport, you got paid one way, $100. And you came back. How much did you make? 100. Now you get 75 there, 75 back. Same thing over here. You could afford to upgrade to a much higher caliber person because you only have to use them once a month. So even if you pay double the pay to get someone, that double the pay was, bottom line, half the price of what you're paying on a monthly basis. And along the way, you have much more insights into deals you're working on. So this is where the wow factor really comes in on the calculations here. So now let's go here for the holding period. Holding period means how long do you anticipate holding on to the property? You're buying the property. Most people that buy a deal buy with intention to keep it for a year, 2 years, 3 years, 7 years to 10. Most times it's 7 to 10 years. An interesting point, the reason why it's 7 to 10 years, and there's a number, is because how long before you're gonna have to spruce up this building? Remember, you did capex, and you're putting money in to spruce it up in the hopes you're gonna raise the rents. 7 years later, or 10 years later, it needs that again. But at that point, you don't want to stop taking money out of the deal and reinvesting every dollar back. So most people say, you know something? I brought it to here. These are my returns 7 years. Let me sell it. The next person will add capex when they buy it. I'll take this money and start again somewhere else. You could debate this from today to tomorrow. Why don't you take it from the beginning of the movie to the end? But yet I found interesting. There are people who have niches and steps in the process that's what they want to deal with. You have people who buy raw land, and they say, I'm going to spend the time and energy to get it rezoned. But the minute they get it rezoned, they sell it. I'm going to get someone's going to parcel a bunch of land together. I'm going to go ahead and just do the construction. I'll just do the lease up. I'm going to do, and there are other people who take it from zero to the end, yes, but for the most part, people become experts in their space, step by step by step of what they want. So let's go back here in underwriting the deal. Let's assume again you're holding it for 7 years. So you take a 7-year hold. Again, we're doing a deal without capex. If it was capex, you'd be able to go and use the transaction and say what year should be stabilized. Now, the next question are assumptions. We just put in that what do you think the rent is going to grow by every single year going forward? For right now, we're assuming 3%. For the expenses, we're assuming 2%. We're assuming the vacancy factor is going to stay at 5%. The reason why we plug out the vacancy in the calculator is because in many real estate deals, many people don't put vacancy in the OM. So they just put the NOI, income and expenses. And you know, hey, you're missing vacancy. If I didn't break it out, you'd have to go into the numbers, calculate under the hood to get this number. But since we see in most cases there's always going to be income growth, expense growth, let the vacancy be a standalone number, what percent you want. With this number, it calculates now for you what the NOI growth rate is going to be compounded year over year. So if you're growing at 3% income, 2% expense with the 5% vacancy, it's 3.7% works out to be the growth rate. Now then it tells you what the projected NOI is at closing. So we have an NOI on the year we started. That was the first tab we did. But now it's telling us, hey, if you're holding the building for 7 years, your NOI at the end of the 7 years is going to be $800,000 and change. So this gives you a snapshot what's going on. But before we go forward, what was very cool and take a lot of pride when this thing was built out is that you can now go into the projected growth rate where the income is going to grow and click on the expansion and say, but in year number 3, I'm not growing by 3%. Every year, you're right, I'm growing by 3%. So how this sheet looks is that you have the T12 first. That was the base year before you started. You put in what you expect the first year's revenue to be, and then it keeps growing by 3% every year or 2%. You want to go and change 1 year. Year number 3, from 3%, let's change it out to 10%. And all you did is that little change. You hit done. You hit done again because now it brought you back, if you wanted the screen, and done again to close out this whole screen. And now you're sitting here, and when it calculated for you, it just brought up that the NOI growth rate went up slightly higher because of that 1 year difference of where you're moving towards. Now let's go a little bit further down, and we're going to talk about the same questions we asked before regarding what is the projected cap rate at sale. You put a cap rate when you bought this building at 6.4. What cap rate do you want to put at sale? Do you think later on you're going to a lower cap rate, the same cap rate, higher? Let's, for conversation purposes, let's just put 6.4, the same exact cap rate that you have from the beginning. Closing costs at sale, at this point you don't have capex. At this point, it's the opposite way. Just, I don't know, I assume 3%, let's put the same 3%. And right now, what happens over here at this point is it shows you all the calculation results of what's happening here. When you close the deal, what's happening, the capital at sale, what's happening to the money at the sale? So first it's going to tell you the net sale proceeds. If you're selling this building with the NOI that it's showing at a 6.4 cap, minus away the closing costs, there is how much you're going to get after closing costs. Then you have the unpaid mortgage. So then we have net distribution from the sale, by just subtracting those numbers. Then you have the total distribution prior to the sale, during these last 7 years, based on all these calculations, how much was distributed, and now you have the grand total distributions. So going back before, if you want to just take cash on cash in theory, that's an easier number. You're just averaging it out, which we have here, 52% average cash on cash, if you look at the bottom result that it has there. But the normal order, what people care about today, the intro is IRR. What is the IRR for this deal? This deal has a 23.81% IRR. And then then you could put in there, what is the equity multiplier? An equity multiplier is telling you that if I put money into this deal, out of pocket $100,000, let's say, and I got back $300,000, my equity multiplier, in effect, I multiplied my equity from $100,000 to $300,000 is a 3x. This metric is used by many big investment funds, but the more accurate one is IRR. The reason is because IRR takes in the time it takes to get there. If I tripled my money in a year, wow, that's amazing. If I triple my money over 80 years, that's a terrible return. IRR blends those numbers together. But different people want to see different numbers easy to them, and that's why we have that calculation that's built in. It shows you the ROI is a return on investment. ROI is basically taking the total amount of money that you invested divided by the total return that you made. And that's the number, not based on a yearly, it's in the aggregate. One big number, pulling it all together. Yield on cost is assuming you take all your costs in the deal, purchase price, closing costs, everything, and you take your return out for the time that it was there, what does the return work out to? And the average cash on cash is taking those proceeds, I said before, the net proceeds, the total proceeds that you got during the life of this investment, dividing it by the years is basically telling you what it works out to an average cash on cash. These aren't really metrics that are common today. We still have them from different times that people look at it. The most important one today is going to be cash on cash for year one and IRR as you're going forward. So here's a very important other piece of the puzzle. Many times people are buying a deal, and during these 7 years, especially if there's capex, there's a value add, there's upside, they might not be going straight from today until the end of the 7 years. They may be during these 7 years either refinancing the building, cashing out some money. So how does that affect the IRR? Or they could do what's called a supplemental, where it's like a second mortgage, but from the same bank. So Fannie Mae, Freddie Mac, the agencies typically allow for supplemental if you come back to them. For the high level, a supplemental has terms, day one, that when you take out this loan, the bank will give you the more conservative of appraised value, the more conservative of the debt service coverage we discussed before. So let's go, for example, as it goes here. So the first number is at the end of what year do you want to do the supplemental? Here's another example I'm saying before. If you might be doing it halfway through the year, and in that case, I'm not giving you those calculations. That's where you'll need the perfected calculations later on. But it gives you pretty close to what you need. So let's say assuming you're doing it at the end of the third year. Then what cap rate do you want to use for that time? You want to use a 6.2 cap. You think the deal's getting a little bit better. Then you want to say, what is the maximum loan to value the bank is giving you? Then, what is the minimum debt service coverage the bank is going to let you have? Similar to what I spoke about before. 1.25, let's say now, is what they want for the minimum debt service coverage period. And then what's the interest rate for that remaining period? Let's assume it's a higher rate. Let's assume 7%. You could say rates are going to go down, but typically it's higher than the initial rates. And then the amortization is 30 years. So now you see the maximum loan is 7.7. Your balance at that time is like $6 million and change. And you're getting out several $100,000 in the supplemental. The closing costs do the same assumption that there's not going to be the same 3% because you're not selling the building. Let's call it 2%. Again, just the number we're making up over here. And then it shows you the property value at the capital event. Now, if you go back and you close this out, go back to the tool, if you scroll back up, you'll see the IRR on this deal went from 23% before the supplemental up to 25%. So sometimes you could say, is it worth all these costs to do it? You don't have to guess anymore. Plug the numbers in and look at it. Hey, there's a 25% IRR versus 23% IRR. Let's go back to the beginning of this whole course. If you went to someone and says, I'm only investing in a deal with a 25% IRR, they'll invest in this deal now. 2 minutes ago, before the supplemental, they wouldn't have. You'd have to go back to the owner, the seller, on the first tab and say, hey, I can't pay you $9.2 million. I could pay you $9.1 million. Or go back to the bank and say, I got to get a lower rate. I got to get more IO. I got to get something different to keep playing with these numbers. You get a question sometimes from your mortgage broker. You get a question sometimes from the bank. And the bank asks you, tells you, I promised you 75% at 6% interest rate. I can't give that to you. Or maybe I could give it to you, but I have another alternative for you. Would you rather take 80% at 6%? At 6.5%? I don't know. Is that a good deal or not deal? Do I need more money, less money? but you plug in the number, you go back to the first page and plug in the number, we'll go back to page 1, and and you start doing for the deal economics, and you just change it from 75% to 80%. And then we change the rate from 6 to 6.5, and we go back now to investment returns, and let's see how that changes. Wow, of course I want to take that deal. It does not so good for the supplemental, but I get to the 25% right now IRR just by that difference. Of course I'm going to go take that deal. Now you're seeing the whole dynamic of a real estate deal at your fingertips. And what did you start with? Easy numbers. Now let's go equity waterfall. This is an area that almost no spreadsheet has. This is the most complicated. You really need someone with a real strong knowledge in analytics and underwriting to really be able to calculate this, and especially if you want to have little complexities. This is really going to tell you the equity waterfall. The terminology of equity waterfall is when the equity comes out. Think about a waterfall. A waterfall goes like this as the water keeps going down. What happens to the equity? As the money starts coming out of the deal, who gets it? How is it split between the partners? There's a GP, that's the general partner, hence G-parency, servicing the whole real estate industry, but providing transparency for the GP and everyone involved in the transaction around the GP. And there's the LP, the limited partner. The limited partner is the investor who invests with the GP. So at the highest level, there could be several GPs, several people together buying the deal, the main people buying it, and then there could be 40, 20, 10, 5 LPs who are investing with them. But a lot of times these become complicated negotiations. The starting point is, okay, I'm going to invest in the deal. And the GP says, yeah, but this is such a home run. After I give you back your money, I want 30% of the deal. You say, no way. No one gets 30% of the deal if off my money. I'll give you 20%, but it's a home run. So they go back and negotiate and say, you know what, let's make the final deal. And listen how complicated this deal could go. They agree that the GP is going to put in 10% of the money, the LP is going to put in 90% of the money. And then they go, let's talk about the hurdle. The first negotiation, when it comes to a real estate deal, like how does everyone make money? Understanding all the sides, like I said before. There's 2 parts in a business. There's the equity, that stays forever. We agree what percent of the deal do I own. That's forever. Then there's an employment contract. People work there. The salary could go up, the salary could go down. They could earn a commission, they could earn profit sharing, but the equity doesn't change. So the concept is, 2 people go into business, they agree to a split. I own this percent, you own that percent. That's fixed. Then, for working, I have to get paid. So the GP would get paid. They could take a management fee. That belongs to them. They get the management fee because they're working it. The people who put up money say, hey, I want my money to also get paid. I want my money to get a salary. That's called a preferred return because I could put my money in the bank. You want me to take it out of the bank, give me some interest rate, and then I'm taking the risk with you. We split the profits at a certain split that they go. So there's a terminology called a hurdle. What has to be hit first, and then this happens, and then what hits second, third, fourth. Sometimes it's easy deals. Sometimes it's complicated. I'm going to show you a deal that has a total of 3 hurdles. The first hurdle would be from 0% return until 8%. There's no promote. Promote means that the GP doesn't get anything special. So we'll start the first hurdle. 0%, type in 8, and now you keep the promote to 0. Automatically, it's going to create the second hurdle is going to open up, starting at 8, right? From what happens from 8 until eternity. But no, you worked out a deal that doesn't go till eternity, to infinite. It goes from 8 till 12. So change infinite to 12. Now, the promotion that's going to go to the GP, to the syndicator, is going to be 20% at that point. And then from 12% till infinite, you're willing to give 35%. What this does right now, if you look at the right side of the screen, the totals, it now tallies up for you to say, okay, in total, that's how much money was put into the deal. We see how much the GP and LP put in. What is the distribution to the GP? The GP distribution is how much money did they take out. The LP distribution is how much of the distribution went to the LP. What is the GP's IRR? What is the total distribution they got? What is the equity multiplier? And the same thing for the LP. So when we had a 25% on the first page, because of this arrangement, the GP is going to walk away with 45%, and you're walking away with 21%. Does that net work out for you? So there's 3 numbers really that at play here. There's the deal IRR, and then there's based on the split of how you're splitting all those profits, who gets what of it. And if you want to negotiate, at least you know what to negotiate. Sometimes I tell people, it just doesn't sound good. 35%, you can only have 30. Go back into the deal and change the number from 35 to 30. See how big a difference it is. Or the lower number, and just play with the number and see, is it really changing the world? If it's changing the world to you, then negotiate it. But sometimes you might ask for something else that's not important to the other party. That's why I spend a lot of time asking people I invest with or I want to invest with me. I want to understand the background. What are they thinking at? What do they want? What do they want to come to? What do they want to get to? And then this way you can understand how to negotiate this. Let's go now to the last tab. The last tab is a simple one. It's just a write-up. So simply put, the first part just writes up the deal. And as you know, I'm big into tech. I like the ChatGPT. So it's more for cute for now, but I'm sure over time will get developed a lot better, is that writes up the summary of the neighborhood straight from ChatGPT. The beauty now is, unlike these complicated spreadsheets, is that now you could actually just click the share button on the top, creates a link, and then you can send it out to people. So when you're finished doing this, you could call up your guru and say, could you please do me a favor? I just underwrote this deal. Could you look it over if I missed something? Or you could call them on the phone. It's so easy. Say, in a matter of 2 minutes, you can probably repeat all the numbers you put into the spreadsheet. One of the things I've built out on the toolkit, on this marketplace, is that when you're here, you could see all the different possible things without calling someone. What are the rates? So you have an idea without having to call someone. You want to just do your own little due diligence. But more importantly also, we have properties that are for sale. We have properties that have vendors on it. I always felt that the due diligence is about people, not about just, buying a report somewhere. Because you never know what questions were asked. Some companies that do due diligence, they do their due diligence, they have people working in a different country, making calls like, hey, I'm calling from blank company, what happened with this or what happened with that, and they can make a human error. Instead, wouldn't you rather call the players in that marketplace? So my advice to you is in due diligence, is before you even go to your underwriter, you want to go ahead and look in that area, are there anybody linked and active in that area? And call up a broker and say, hey, I see you know the area, to get another opinion. The main assumption numbers, what cap rates are buildings trading at over here? What can I expect rents per unit? So you can know, hey, if this building has 30 units and this is the rent, I could expect potential gross income to go to this way. Are things on its way up? Are they flat? Are they down? If things are on the way up, you might go and not use a 3% growth rate, maybe use a 4 or 5% growth rate. In the height of inflation, I saw people underwrite a deal assuming they're going to get 6% for the next 10 years. Inflation's here forever, right? It's not at the same 6%. Markets keep changing. But when you start talking to people, you know what you can plug in the numbers. Once you think you have the right deal, the time you want to really go ahead as to go to the underwriting is the pre-NOI underwriting. And that's where I want to leave you at this point. So to recap the education, when you hear about deals that went sour, most of the deals did not go sour because the NOI was off. Because at a high level, you notice certain things. Most deals that went off in the assumptions from this point, from the NOI, what cap rate to apply, what's the projections going forward, were you able actually to borrow the money you thought you could borrow, did your equity come in at the right price, what was the deal between the partners, were you able to play it out, did you really calculate what would be that when you did an assumption you could do a refi, did you use what cap rate? When you told me I have a 25% IRR, for example, what cap rate did you use when you were selling the building? That's a question to ask. I see people say, rates are coming back down, so in 7 years, I could use a 5 cap again. Other people say, you're crazy? Nothing less than 7, whatever the number is. But that's where these deals go sour. And that's really what I think is most of the due diligence should be focused in this area. I want to thank you very much. I hope this is beneficial to you. And if there's anything I could ever help you, as I make an offer always to people. I'm going to give you my cell number here. It's 917-597-2197. My email address is iraz@gparency. Feel free to reach out to me if I can be of help with anything. Thank you very much.